Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. It's a truncated week for the Indian financial markets, with Tuesday and Wednesday being a holiday for Independence Day and Parsi New Year, respectively. However, global markets carry on. We have been seeing some dollar strength today morning, a continuation of the theme from last week. A Japanese yen hovering around the 145 mark. China's property giant Country Gardens 2024 bonds is yielding 2,500% or trading at 9 cents. While that's causing a lot of pressure even on Chinese yuan. Chinese yuan has continued to weaken despite stronger fixing by the PBOC. Good morning, JK. Dollar strength continues. How are you seeing the market this week?
Good morning, Swaraj. Yes, dollar strength is definitely entrenching itself, actually. Uh, the steady rise in yields, the weakness in other economies like Eurozone and China, apart from the oversold state of the dollar against major currencies, particularly the euro, which looks quite overbought, these are actually pushing the dollar higher. And we are also not getting any good news from other economies, so that continues to see the currencies being sold. And of course, China and yen stand out as the weakest currencies, mainly because of their extremely negative yield disadvantage against the US, which keeps going up. And of course, we had more evidence of inflation in the US on Friday. It gave some mixed signals, like complicating the future expectations on the monetary policy. Producer prices increased more than expected in July, somewhat slightly more than expected, as cost of services rebounded at the fastest pace in nearly 1 year, and that trend is consistent with moderation in inflationary pressures. Data was revised also for June to the lower side. Therefore, overall, it was, I would say, unchanged for the last 2 months. But the prices of goods and outside food and energy were also unchanged. So goods inflation was in place, but the services side, which we have been hinting at for several days, is remaining sticky. It's keeping the inflation overall kind of entrenched. On the other hand, consumer inflation expectations, as measured in the University of Michigan survey, unexpectedly fell in August, both for 1 year and for the longer tenor of 5 years. And that, of course, the fall was just 0.1%, but the direction has been down. So the divergence actually indicates an uneven path ahead for inflation that is overall moderating. Uh, we don't have too many indicators from now till the end of the month as to the course that will be taken by Fed in September. But as of now, more than a good majority prefer a unchanged stance by Fed in September at least. But we should look at how the PCE core inflation, which actually derives in influence from the services inflation, will pan out. And then one more unemployment report will be there for Fed to digest before they come out with their decision in September. We had also the UK GDP that surprised to the upside. That was the only good news outside of US, and the larger than forecast 0.5% rise in GDP in June meant that it grew 0.2% in the quarter compared to last 3 months, and that's quite an acceleration. But this is only looking beyond the current numbers. Actually, UK is one economy which is yet to reach the pre-pandemic levels of GDP, and moreover, most analysts also expect the big rate rises by the UK central bank to bite into the economy in the coming months. Therefore, not too much to take over. Again, it's very clear, the pound has not reacted much positively after this apparently strong looking number. We had more negative news from China. The loan survey, actually the offtake of loan in China has been quite dismal, and that is another sign of weak demand in China, adding to a raft of negative reports showing deflation in the economy, plunging exports, and a slump in manufacturing activity. On top of that, of course, property market crisis is also worsening, as you indicated. One of those companies' prices, the bond prices are almost available at throwaway prices. Now, even there was one more indicator that China vehicle sales. I'm referring to the vehicle sales because recently China introduced some measures to boost purchase of automobiles by the people, but that has also fallen for the second month in July. So all these numbers have not helped Chinese yuan to post any sort of recovery. In fact, we are now trading well above 7.27. The fixing of the yuan was almost 10 figures lower than what we are seeing in the market. So clearly, market does not pay heed to what the central bank is trying to convey. So staying on the dollar, of course, euro has come to a very crucial support near 1.09, a trend line drawn from September lows of last year, and which went all the way up to 1.1279 in the recent rally, has fallen to the support, and a clear breakthrough 1.09 could be could see a good fall in the euro, and that will actually push up the dollar index as well. Even the Japanese yen is at a very sensitive level of 145, as we have mentioned earlier also, and the actions of Japanese authorities or their verbal intervention can be expected at this point of time. We do not have any major trigger today for the dollar to make a fresh rally, but definitely it will hold some sort of tentative support for the time being, waiting for next trigger. We have a lot of data this week: U.S. retail sales and the U.S. housing market, apart from the German ZEW numbers and UK inflation numbers. All of these are very important. Coming to Indian scenario, indications are that we are going to open above the crucial resistance of 80 to 85 today, which had been well protected by the central bank so far. But as we are moving higher, along with factors which justify the weakness, like the Chinese yuan moving higher above 7.27, the US yields moving higher, some sort of slippage in the inflows into India. All these things are indicating that central bank should be okay with a bit more modest weakness in the rupee, although we will bump up against a very strong resistance at 83, 83.10 and 83.30. These levels are likely to hold in this cycle, according to me, unless we have a break above 104 in the dollar index, which is not ruled out, but may happen only with some measured moves. So watch out, because we also have CPI data from India. Levels up to 6.5% has been discounted, but any number exceeding that can be negative for the rupee. More importantly, after this data and a lot of international data which will come out, and tomorrow and after tomorrow, can only be acted upon or reacted upon by the Indian market on Thursday, because we have two consecutive holidays coming into the market. So we'll see. We might well see some gap up or gap down opening, depending on the events, interim events. And current bias is that we should be trading former USD in the coming days. Thank you.
Thank you, JK. And as you mentioned, dollar strength is the theme. We are seeing steady rise in yields, weakness in other economies like EU and China. Basically, lack of good news from other economies is leading to a good news for the dollar bulls. While market is pricing in an unchanged rate decision for the September Fed meeting, we had a good surprise when it came to UK GDP, which came for the upside for the month of June, and UK is yet to reach the pre-pandemic level of GDP. That's it from us today. Currencies are at very sensitive levels, so keep managing your risk. We'll see you all on Thursday after this long break. And let's catch up then and see how markets are performing. Thank you so much for listening.
And happy Independence Day to all.
Yes, happy Independence Day to everyone.